Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update here for May 16th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything we talk about here today is just my own opinion, not a direct trade recommendation. But what a day it was. We had soybeans really leading the way for price action that's really noteworthy. Um, have to double check this, here, but it is interestingly enough, most of the day there, I should say, new crop corn. I was going to lead with this example of how it was a weird day. Was higher highs and higher lows for most of the day, and of course, it came down to make a lower low there and an outside day. Beyond yesterday's, highs and lows there for Monday, with a rather bearish development. Flip my screen over here. Rather bearish development, right, from the day-over-day technical buildup that was otherwise starting off today looking like could have been the start of a little reversal and some short covering back towards that 18-day moving average and maybe even a little above towards the highs of last week. That never came to fruition. So having closed inside yesterday's range still, certainly leaves a little bit of a breadcrumb on the table that if bulls rally this back up to today's highs and through that 10-day moving average, okay, this is all just a fight and a wrestling match over the trend. And when we take a step, back in time and we look at old crop, well, old crop has almost no direction here since the start of May. Today, again, was holding inside price action to yesterday's candle. We made a lower low. But generally speaking, the last 5 days of price action, we've been just completely sideways inside of a range with being unable to break below 575, 570, unable to break above $6, giving us a 25 to 20 cent range for old crop corn. With new crop, the last 3 days at least kind of being range bound above $5. So not much going on there. We'll come back to corn charts. Today was really, like I mentioned, for the soybeans, was alluding to and had started off with there, was a day where, the chart that certainly had me reflecting the most at the end of the day is this daily chart of that is up on the screen here in front of you. This is a daily continuation chart of soybean oil. So every candle here is a daily candle, and over the last couple days we have been breaking the neckline for what could be construed as a head and shoulders pattern on this daily chart, where the neckline would be down here around the 50 figure. The left shoulder was formed the whole year of 2021. The head here of the pattern was the big rally in 2022, and when we hit kind of peak inflation everywhere. This was also on the back of discussing this more with my colleague and our chief market strategist Ted Seifried over here, that what are we seeing envelop here in the bean complex, right? We've seen producer and crush margins go from some of the best levels back in 2022 to now some of the worst levels in the last 5 years. Over that same period, right, there's been a narrative of the biofuel mandates, and ideally that biodiesel mandate, where we were hoping that demand could come in and continue, right, bean oil. We built in the premiums for that demand, and arguably that was probably a big reason we broke above $50 and ran to 87, 90, and effectively doubled, quadrupled the price of a barrel, right, of soybean oil. And that's something that I think now is coming into question now that bean crushing margins have flipped that script, right? Now we've unwound a lot of that premium here in the oil complex. From a technical perspective, we're going below a major line in the sand that technically opens the door for a head and shoulders break lower, but not to get too doom and gloom here for bean oil, because remember, these technicals, while it's signaling for a breakdown here over the last couple of days of a head and shoulders pattern that's taken 2 years to uncover, we very well could snap back above 50, go through the highs of the month, and that's all a kind of a gotcha head fake to this pattern as well. But there is writing on the wall here that if crushers and crush capacity was expanded so much over the last few years, and demand's not there, well, we're just making more, right, of a product that it isn't being, bought up as much. Well, simple supply and demand economics, unfortunately, cause for price reductions when a commodity is oversupplied relative to demand. And there is, of course, other kickers in the hole here, right? Canola coming up in the last round of EPA regulations to be announced as being on par for U.S. mandates for biofuel blending with bean oil in that production. That's not great for our oilseed or for our bean oil producers, or for our soybean producers, I should say. And that little piece of the puzzle helps Canada and Canadian canola producers a little bit more. Then there's the other caveat now of other different varieties of bio oils and lipids being able to use, including animal fats that are included now in this production cycle, that find bean oil with a competitive advantage at the prices we are at. So lots happen here to unwind fundamentally. Now we're through some technical levels on the chart. I'm a little fearful that these are levels and places where things and funds tend to lean into a little bit, and it can get rather bearish rather quickly, if not already. So we have this downward sloping channel in the bean oil. Trendline resistance would be up around the 55 and 100-day moving averages, depending on how you draw it. There's a couple varieties, but generally speaking, right, they're just lines in the sand we'd have to pass through on the way back up, because we've broken through supportive levels that are very important. 18-day moving average and 10-day moving average are up there around the 52 figure. 55-day at 54. 84, 57.97 for that 100-day, and the 200-day remarkably still way up there at 60.53. But we're not going to have to spend too much time down here to get those all rolling a little bit lower. So I think by the time bean oil has bottomed, all of these moving averages will have dropped a little bit more, just because we've gone so far down on the chart. Rallies at this point back up into old support, now resistance in that 50 to 54 area. It aligns with our 55-day moving average, the downward sloping trend lines and channel resistance, and of course the old support that we've, I think, effectively broken below, and a rally back to test it wouldn't be out of the question here. I think it's tough to be a buyer for that rally because you're catching a falling knife in every in every conceivable way right now. But if a rally happens, right, if we can identify a day-over-day trend reversals reason, okay, there could be a significant short covering rally in this type of market. And on a day where beans are down so much more significantly than corn and wheat were, and the charts day over day have looked very different. I mean, beans are pretty locked in a downtrend right now. Corn's putting up a fighting chance in old crop. New crop doesn't look great, but you can make a case that we're certainly not pressing multi-year lows right now for I guess we are a new crop corn, right, but not an old crop. But it's a different chart, right? Each what I'm trying to get at is each market has a very different look to it. And you have to be, we can't be falling asleep here with the idea that there's a lot of correlation, right, going on. Is what I was alluding to, and putting extremely poorly into words. All right, so bean oil breaks for a lot of reasons that we can discuss and continue to discuss, but we got to move on to corn and wheat and talk about some other price action here. But that obviously weighs on soybeans, right? If crush margins are at 5-year lows effectively, and we rolled over what little bit of constructive rebuilding of crush margins were happening there over the last couple of weeks, that has been kind of unwound again. Soybean prices have to come down. And just a quick look, I guess, at the meal chart before we go right to soybeans. Meal down a little bit today, but back above that 18-day moving average and back above that 200-day moving average. Meal looked a lot more constructive. We thought we might be seeing a reversal here. You could. I mean, this might be 2 steps forward and 1 step back, but tough when the rest of the complex is falling apart, right? But meal prices being relatively stable while soy oil prices fall and drag bean oil prices low, soybean prices lower, that's kind of how, right, margins for those spreads work themselves out. But nevertheless, bean meal staying relatively stable at these prices isn't a bad thing, is what I'm getting at. and everything kind of not going with beans puts this as a bean-centric move. So if beans get their act together and do find some kind of support here, not necessarily today, but some point in the future, it'll be more of a showcase of strength, right, than for the broader row crops, right? Kind of a rising tide thing. When the most bearish asset stops being bearish, it gets interesting. And that kind of happened last week too with wheat, right? Wheat completely reversing. Anyway, soybeans themselves broke through that key $14 figure, which was where trend line support was coming up. It was the support basically through September and then March again of this year. Through that figure, we ignited stops. We've wiped out now a year's worth of support, and we're now fighting, our way down to that 1354 gap fill. 1351 was the close from that day on July 26th. Really close to a gap fill here. I would have loved to just kind of get it done, but I am of the opinion that we will probably see some follow through of today's price action, a little bit lower to fill that gap. We just kind of turned over sold in the daily RSI, so today's the first print, so to speak, of double goose eggs, or the 000s that you get when you kind of hit the low end of the range for oversold territory in RSI. And we aren't showing any indication, right, of support just yet, not even like, a daily bounce. I think the biggest bounce we had in all of today's price action, unfortunately, for soybeans, let's go take a look at the short-term chart. Well, before we do that, 200-day moving average all the way up there at 1460, and the 100-day above that at 1477, with the 55-day at 1452. If we do see any kind of major snapback, I mean, to me, that cluster is in reversion to the mean is what we'll be talking about and looking for. But for the time being, we're still in a downtrend, right? July beans 4-hour chart. Okay, so from April's high, 1501, down to 1392, the lows of May, the lows of April there before May began. We unfortunately, we've been also having to cover, right, this downtrend that we might be starting in the soybeans. 50% short there at 1446 held, right? And then we've now traded down to the 1366, negative 23% swing target from that type of 2 steps down, 1 step up. We've taken 2 steps down now into targets where the gap fill is, what have you. Extensions could take you down to 1325 from that swing. Inside that trade, right, after they traded the 1446 high, market went down to make a new low, got a little bit of a rally there just Friday and yesterday into 1420. 1416 was the 50%. 1420s, you could say, was sure the big figure on the chart, but 1416 from 1446 highs down to the 1385 low of Friday, or Thursday, excuse me. That was 50% short at 1416. So downward, side swing targets of 1370 were filled there. So now I start drawing from 1446 high. That was the last actionable swing set up down to the new low. 1402 becomes resistance in the 50% of the next in the series. Well, wouldn't you know it, that aligns with where that upward sloping trend line is on the charts. If we want to go back to test it now as resistance, it's where the support had been since September of 2022 that we broke through at 1385. So 1386 to 1401 now is going to be a tough nut to crack and get back through. And for me, no matter what the balance sheet says at this point, everything's a moving target. We've broken through a key technical level on the chart. I can't ignore that. And until we get back above 1401, really above 1410, and kind of stay there, I'm comfortable letting this market fall. Now, that doesn't mean that on a rally, you don't think about being a short or a seller into these technical levels. A rally back to 1401 in July beans is, probably going to give a significant, somewhat of a significant bounce to Novi beans as well. Not saying we get above 1250 there, but okay, I'll move back to 1240 to 1250. If we bring up a chart of that November bean, is a, the the similar type of area on the chart that July broke through. It just did it a couple days before, because those new crops charts have been a lot more, have become more traded, right, for the weather events or the weather markets that we're trying to price in. And unfortunately, no matter what you think and you see in drought maps and what have you, the market is taking premium out. The question, right, is now how much more needs to come out, if any, right? And I don't know, but I do know we're below some key technical levels where I wouldn't chase the selling now, but the first bounces and first rallies back here makes sense to maybe take a stab at being a short seller, or even looking at these reversal opportunities. I shouldn't call it a reversal opportunity. It's not. It's a well, we used to call it a KYM, or kiss your mother, but you break through a broken support and you come back to test it as resistance. It's just a retest, a back and fill, kind of retest setup. And if it doesn't hold and it fails out, then there's a reason to get long again and be a part of the long back in the swing, higher. And that's the objective trading mentality that, right, we try to talk about and uncover for ourselves, because we can't fall in love with any one side at any moment. The market over the last year has proven that to any trader in the row crops, that's for sure. All right, so corn in the July contract here, we talked about it a little bit, kind of been sideways below that 18-day moving average, fighting to get above the 10-day. Yeah, that's the line in the sand to the upside in the near term, basically $6. Below 580, below 570, we continue the downtrend. We've unwound the oversold condition on the daily RSI, so there's room to the downside now if the market wants to go there. In other words, we spent enough time going sideways that we could make new lows and not be oversold. So, there's sometimes you don't have to rally to unwind, oversold conditions. Sometimes we just go sideways. But, I'm still watching $6. I'm still watching the 18-day moving average, which is at 1591, basically highs of today. Certainly, if we get up and through those levels, the ability for this market to short cover or see weather premiums to be built back in can be very quick, right? Anyone who's been doing this long enough knows that. But you can't deny we also have, trend lines that we've continually broke through to the downside that on the way back up have acted as resistance. And in July corn, there are, similar levels of, the $6 area. And I think we're kind of chewing and trying to chew through some support here, right? That proved itself last summer on the chart. And if it can't hold, it can't hold. And reversions to the mean, right? Not saying we couldn't go to 750 corn if we saw a, string of very, very, very bullish news, including weather events and crop loss and exorbitant exports, right? But reversion to the mean for just the last 55 days would at least take you back to 612. 100 days would take you back to 634. And 200 days takes you back to 650. Now, those are levels that I don't think are totally out of the question in a short cover or in a rally. In fact, if you look at the last, several rallies in corn we've had, even in this bear market since last November, and it has been, we have seen rallies to the tune of 60, 70 cents. It's just a matter of I guess 50 cents there, right? Because it was $6 up to $6.49. So doing it again isn't out of the question, but in the short term, right, you got to get focused on what's happening here and now, because if it doesn't do steps A, B, and C, you can't get to step E, F, and G, right? All right. December corn 505, test of the $5 figure is what's kind of going on. That's down into the 6,218 line and really dipping into, if you took from, the COVID lows to the highs after, it's a big three-wave move down. We're really, though, had been starting to accelerate lower. 18-day moving averages at 527, the 10 days at 520, and we've been only barely popping our head out of oversold conditions. The big line in the sand now, this 545 to 550 area, is kind of the inflection zone we've broken below. So again, any kind of short covering rally, we'll be looking for it back up to that area. Hey, I'm telling you, these areas up there, these are more for our producers and people looking to get hedges on and be sellers. If we get those moves, we'll talk more about them in detail. But in the near term, we're still in a downtrend. There aren't great there isn't much to sink your teeth into and say that the reversal's happening. We'll continue to look for it, but we're going down until we're not here, and that's unfortunately right. Just the way the cookie is crumbling. Last but not least here today, because there isn't much to talk about in the short-term charts for corn, certainly not for July corn. We're sideways again. I'd love to see it break above $6 or below 570, just to reset kind of some of the trade in the market. All right, so downward sloping trend lines against the highs for Chicago wheat would come in around that 55-day moving average around 680. The very near term, we're trying to get above our 18-day moving average there and kind of stay there. Tight 20-cent range for Chicago wheat. Looks like it's trying to bottom. Can't get above this old support. Now resistance, though, at 670. That's certainly like, if you want to be a little more conservative and start to go with the strength, that's where we're starting to go back into the, on the daily chart, starting to make some progress again, right? In the near term, though, right, we have a 20-cent range to follow and watch. And I certainly think we can all appreciate how oversold this chart got in many metrics when we were down at the lows of May that might need to unwind. So far, though, little trapped here inside and below the 670 area, above 625, and in the very near term, right, in the last 2 days, we've been between that 665 high and the 645 lows. We are a little lower today, but generally speaking, about a 20-cent range in the very near term. Chicago wheat, very different look than our KC and our spring wheat. KC was down 3 cents today, but generally looked good. Spring wheat was up 5 at the end of the day. KC wheat's run into the $9 figure, but we are above every moving average. We're above the highs here going back through February and March. I mean, you actually have to go into last year again to get back to these levels again for July KC wheat, which is a really impressive recovery. But it needs to stay generally up here, because any weakness in the strongest of all of our charts right now would not be a good look, because it would show, I think, everything kind of deteriorating. But each market we've seen has had, even intra-crop years, we have had very different trends and dynamics playing out. And when you look at our spread charts, which we'll cover more in Thursday's Strategy of the Week webinar, you can see how the spread markets have had prolonged and very prolific trends, some of which are at 30 and 40 year extremes. When you look at corn to wheat ratios and stuff, or hit them. But KC wheat, overbought conditions, has this trader a little concerned that today's inside price action with the weakness we're seeing elsewhere in the chart and the failure to break above $9 is not great, but I would, it's one of those reminders that, or whenever I'm looking at a wheat chart, I always like to remind myself of its ability to process a pullback. You can look just back only a few months and weeks to see some of those sell-offs. 884, for example, down to 836 in just 2-3 days, and still rallied, 40 cents off there, and still irked out a new high even after. Those types of pullbacks that test some of these bigger levels. The 200-day moving average is now below us at 868. Aren't out of the question. So keep this, it's my opinion to keep the stops tight here. Lock in your gains if you have them. If it drops, starts to roll over, take your gains, get out, let it drop, and don't be surprised when it drops a little bit more than you might be expecting to, because things have been very volatile. All right. Well, anyway, that kind of concludes today's strategy of the day. We're going to see if this weakness in soybeans continues, into the end of the week. If that, continues to be a drag on the rest of our row crops. And really, tomorrow, if corn responds negatively and proverbially plays some catch up, and, July corn starts to break down as well, it's going to be very hard to continue looking and thinking about a narrative where a bottom will form. But we've already broken so far that you do have to wonder, have we started to unwind some of the, the pendulum has, so to speak, has it swung the other way now And are we starting to get a little too overly pessimistic on price? It's really the million-dollar question for this year. And certainly price action into the end of this week is going to help us, at least from what we've seen in the short-term charts, help us confirm or deny a lot of that consensus. So you can always get in touch with me over here at Zaner at 312-277-0110. You can find me on Twitter at Daniel Hussey Jr., Dan SOTD right here on Facebook, or shoot me an email at dhussey@zaner.com. Join me every Thursday at 1 p.m. Central for the Strategy of the Week webinar. I'll cover these markets and a lot more. You can sign up for that, those events, and that to get that video and webinar link in the comment section in the information section of this video. Leave your likes and your comments below. Thanks for joining me. And until next time, everybody, have a great day. And I'm Dan Hussey with Zaner Ag Hedge. I'll be back with you as price action develops.